Something shifted in the financial markets this week. And if you hold gold, silver, or have been watching precious metals as part of your long-term strategy, you felt it. Prices dropped sharply. Headlines screamed crisis. Social media filled with panic and celebration in equal measure. And beneath it all, a deeper story was unfolding, one about debt, currency, and the slow-motion reorganization of global finance. This isn't a video about what price gold will hit tomorrow. This is about understanding what's actually happening right now, why it matters, and how thoughtful investors navigate moments like this without losing their discipline or their capital. Because here's the reality, most people will react to this news emotionally. They'll make decisions based on fear or greed, on headlines rather than fundamentals. And in 6 months or 6 years, they'll wonder why their portfolio didn't reflect their intentions. If you're here, you're looking for something different. You're looking for clarity. So let's walk through this together. Let's talk about what changed, what didn't, and what it means for anyone who takes wealth preservation seriously. Let's start with the facts, stripped of emotion. Gold and silver experienced significant price declines recently. Not a minor correction, a sharp, attention-grabbing move that sent both metals tumbling in a matter of days. Gold dropped from recent highs, silver followed even more aggressively, and the precious metals community found itself asking a question many thought they'd answered years ago. What just happened? The immediate trigger appears connected to China. Specifically, reports and data suggesting that China has been reducing its holdings of U.S. Treasury securities, diversifying away from dollar-denominated assets, and potentially reassessing its currency strategy in ways that ripple through global markets. This isn't speculation. Central banks report their reserve positions. Trade flows are documented. The moves are real, even if the interpretation of those moves varies wildly depending on who you ask. At the same time, the dollar showed unexpected strength. When China or any major holder reduces treasury exposure, conventional wisdom says the dollar should weaken. But markets don't always follow the script. In this case, short-term dynamics, including safe haven demand and positioning by large institutional players, push the dollar higher temporarily. And here's where it gets important. When the dollar rises sharply in the short term, assets priced in dollars often fall. Gold and silver, which trade globally in dollars, become more expensive for foreign buyers. Demand adjusts, prices correct. This is mechanics, not mystery. But mechanics matter because they help us separate signal from noise. Here's what you're hearing right now if you spend time on financial, social media, or mainstream news. One camp is declaring that gold is dead, that precious metals were a fantasy all along, and that anyone who believed in them as a store of value has been proven wrong. They point to the price drop as evidence. They feel vindicated. The other camp is screaming that this is manipulation, that powerful forces are suppressing prices to hide inflation or protect the dollar, and that you should buy everything you can afford right now because the real price is being hidden from you. Both camps are responding emotionally, not analytically, and both are missing the larger picture. The truth is more nuanced and, frankly, more interesting. Gold and silver are not stocks. They don't have earnings reports. They don't grow revenue. They are monetary assets, stores of value that exist outside the traditional financial system. Their role in a portfolio is not to outperform tech stocks in a bull market. Their role is to preserve purchasing power over long time horizons, especially during periods of currency instability or systemic stress. When prices drop sharply, it doesn't invalidate that role. It reveals something about market psychology, about positioning, and about the difference between price and value. Price is what you pay. Value is what you get. And sometimes those two things diverge dramatically in the short term. What we're seeing now is a repricing event driven by near-term dollar strength and position liquidation. It's painful if you bought recently at higher prices. It's confusing if you expected a straight line up. But it's not a fundamental rejection of the reasons people hold precious metals in the first place. Those reasons, currency debasement, debt expansion, geopolitical instability, central bank policy uncertainty, haven't gone away. In fact, some of them have intensified. Let's dig deeper into the China component, because this is where the story gets more complex and more important. China holds enormous quantities of U.S. debt. For decades, this arrangement worked for both sides. China exported goods, accumulated dollars, and reinvested those dollars into treasury securities. The U.S. got cheap financing for its deficit spending. China got safe, liquid assets to park its reserves. But that relationship has been shifting for years, slowly at first, then more noticeably. China has been diversifying its reserves. It's been buying gold, lots of it, through official channels, and many analysts believe, through unofficial channels as well. It's been encouraging bilateral trade in yuan. It's been building alternative financial infrastructure through initiatives like the Belt and Road, digital currency development, and commodity agreements that bypass traditional dollar settlement. The recent acceleration of treasury reductions is part of this longer trend. It's not panic, it's strategy. China is not trying to destroy the dollar overnight. It's trying to reduce its dependence on the dollar over time. There's a difference, and that difference matters for how we interpret market moves. When a major creditor reduces its holdings of an asset, that asset's price should theoretically fall. In the case of treasuries, yields should rise as China sells and buyers demand higher returns. And when treasury yields rise, it often strengthens the dollar in the short term because higher yields attract capital flows. But here's the paradox. A stronger dollar in the short term can mask a weaker dollar in the long term. If the reason for dollar strength is that foreign holders are exiting long-term positions and the Fed must eventually respond with more accommodation, then what looks like strength today could be setting up weakness tomorrow. This is where most casual observers get lost. They see the dollar rally and assume the crisis narrative was wrong. They see gold fall and assume the fundamentals changed. But the fundamentals didn't change. The market's interpretation of the timeline changed. If you've studied gold and silver over multiple decades, this moment feels familiar. Not identical. No two market periods are exactly the same, but familiar in its psychology and structure. Go back to 2013. Gold had risen dramatically from 2008 to 2011, driven by quantitative easing and financial crisis fears. Then it corrected sharply, falling from over $1,900 to below $200 over the next few years. During that decline, the narrative flipped. Gold was declared dead. Investors who had bought at the top felt betrayed. The mainstream financial press moved on to other stories. But something interesting happened. The fundamentals, central bank balance sheet expansion, negative real interest rates, growing debt to GDP ratios, didn't reverse. They paused briefly, then resumed. And by 2019, gold was climbing again. By 2020, it broke through old highs. The people who understood cycles and fundamentals didn't panic during the 2013-2015 correction. They accumulated, they stayed patient, and they were rewarded not because they predicted the exact timing, but because they understood the underlying forces. Or look further back. The 1970s saw gold rise from $35 to over $800 as inflation raged and currency crises mounted. Then came the 1980s and 1990s, 2 decades where gold languished as real interest rates stayed positive and faith in central banking remained strong. Many declared gold obsolete. Then came 2000 and a new cycle began. The lesson isn't that gold always goes up. The lesson is that gold responds to specific conditions. Real interest rates, currency stability, debt sustainability, geopolitical risk. When those conditions favor monetary metals, prices rise over time. When they don't, prices consolidate or fall. Right now, we're in a moment of sharp repricing, but the underlying conditions, unprecedented debt levels, persistent inflation above target, geopolitical fragmentation, central bank uncertainty, remain tilted toward long-term support for monetary assets. The question isn't whether gold and silver have a role. The question is whether you have the temperament to hold them through volatility. If you're watching this and you already own physical gold, silver, or exposure through ETFs or mining stocks, you're feeling this correction in your portfolio. Let's address that directly. First, ask yourself why you bought these assets in the first place. If you bought because you saw a price chart going up and wanted quick gains, then this correction is painful, and you may be questioning your decision. That's understandable, but it also suggests the position wasn't built on a solid foundation. If you bought because you understood the long-term case for monetary metals, protection against currency debasement, portfolio insurance, a non-correlated asset during systemic stress, then your thesis hasn't changed. What's changed is the price you could sell at today versus last month. Unless you need that capital immediately, the mark-to-market loss is temporary. It's psychological, not realized. Here's what disciplined holders do during corrections. Nothing, most of the time. They don't panic, sell into the decline. They don't check prices obsessively. They don't let short-term volatility override long-term strategy. They might rebalance if their allocation has shifted significantly. They might add modestly if prices fall enough to create value opportunities. But mostly they wait. They trust the process they established when they first built the position. This is where emotional control becomes your most valuable asset. Markets will test you. They will show you losses on paper and whisper that you were wrong. Your job is to separate temporary price moves from permanent loss of capital. If your time horizon is measured in years or decades, a few months of volatility is just noise. If your time horizon is days or weeks, you were never investing. You were speculating. And speculation without discipline is just expensive education. Now, let's talk to those of you who don't currently hold precious metals but have been watching, learning, considering. This correction creates an interesting opportunity, but only if you approach it correctly. Lower prices mean better entry points, all else being equal. If you believed gold was interesting at $2,400, it's more interesting at $2,100, assuming the fundamentals haven't deteriorated. Same logic applies to silver. But, and this is critical, this is not a signal to rush in blindly. The best way to build a position in volatile assets is slowly, systematically, and without trying to catch the perfect bottom. Nobody rings a bell at the lowest price. Nobody hands you a guarantee that today is the day to buy. Markets can overshoot in both directions. Gold could fall further before it stabilizes. Silver, with its smaller market and higher volatility, could swing even more dramatically. So what do? You define your allocation first. Decide what percentage of your portfolio makes sense for monetary metals based on your overall strategy, risk tolerance, and financial situation. For many conservative investors, that's somewhere between 5% and 15%. For others, it might be different. Then you execute that allocation over time. Dollar cost averaging, buying in tranches, building the position gradually. This removes the pressure of timing and reduces the emotional weight of any single purchase. And most importantly, you educate yourself. Understand what you're buying and why. Read about monetary history. Study how gold and silver have performed during different economic regimes. Learn the difference between physical ownership, ETFs, mining stocks, and derivatives. The worst thing you can do is buy out of fear or FOMO without understanding what you own or how it fits into your broader financial picture. This correction is not a crisis, it's a teaching moment. Use it to learn, not just to react. Let's zoom out and look at the structural forces that will shape markets over the next several years, because this is what really matters. We are living through the most indebted period in modern financial history. Global debt, government, corporate, and household combined, exceeds $300 trillion. Debt to GDP ratios in major economies are at or near historic highs. Interest payments are consuming larger portions of government budgets. This debt cannot be repaid in real terms. Everyone who studies these numbers seriously understands this. The only questions are, how will it be resolved, and over what time frame? Historically, governments facing unsustainable debt have three options: default, austerity, or inflation. Default is politically catastrophic and economically devastating. It's the last resort. Austerity, cutting spending, raising taxes, paying down debt, is politically difficult and economically painful. Very few democracies choose this path voluntarily. That leaves inflation. Not hyperinflation necessarily, but persistent, elevated inflation that erodes the real value of debt over time. This is the quiet default, the one that lets politicians avoid explicit consequences while transferring wealth from savers to debtors. Central banks understand this dynamic. They talk about price stability and 2% targets, but when faced with the choice between defending currency value and funding government deficits, they consistently choose the latter. This is the environment we're operating in, and it's the environment that ultimately supports monetary metals over the long term. China's moves to reduce dollar dependence, the shift toward multipolar currency arrangements, the growing interest in gold among central banks globally, these are all responses to the same underlying instability. When you see a correction in gold or silver prices, you're seeing short-term market mechanics. When you see central banks buying gold for 13 consecutive quarters, you're seeing long-term strategic positioning. Which signal matters more? Let's talk about the psychological traps that destroy portfolios during volatile periods. The first trap is recency bias. When prices are falling, it feels like they'll fall forever. Every down day reinforces the narrative that you were wrong, that the thesis is broken, that you should have sold earlier. But markets don't move in straight lines. Corrections feel permanent while you're in them. Then they end, often abruptly, and the narrative flips again. The second trap is trying to time the bottom. You see prices falling and you think, I'll wait until it stops falling, then I'll buy. But by the time you're certain the bottom is in, prices have already recovered significantly. You end up buying higher than if you just executed your plan systematically. The third trap is over-leveraging. Some investors, seeing lower prices, decide to borrow or use margin to amplify their position. They believe they're getting a bargain and want to maximize returns. This is how people blow up their accounts. Leverage turns volatility into catastrophe. A 20% correction in an asset you own outright is uncomfortable. A 20% correction in an asset you bought with 50% margin can trigger liquidation and permanent loss. The fourth trap is following crowd psychology. When everyone is euphoric, risk is highest. When everyone is pessimistic, opportunity often emerges. But it's emotionally easier to do what everyone else is doing, even when logic suggests otherwise. The investors who build lasting wealth are the ones who resist these traps. They stay disciplined when others panic. They stick to their plan when markets test their conviction. They think in probabilities rather than certainties. This is important enough to deserve its own section. Let's be explicit about the mistakes to avoid during this period. Do not panic, sell your physical gold or silver because prices fell. If you built a position for long-term reasons, those reasons haven't changed. Selling now locks in losses and removes your hedge right when you might need it most. Do not chase headlines or predictions. Someone on social media will tell you gold is going to win $500. Someone else will tell you it's going to $5,000. Both are guessing. Neither has a crystal ball. Your job is to focus on fundamentals and probabilities, not forecasts. Do not buy more than you can afford to hold through volatility. If putting another 10% of your savings into silver means you'll lose sleep or need to sell if prices drop further, you're overexposed. Size your positions appropriately. Do not use leverage or derivatives unless you truly understand the risks. Futures, options, leveraged ETFs, these instruments can amplify returns, but they can also amplify losses beyond your initial investment. They're tools for sophisticated traders, not substitutes for patience. Do not ignore the rest of your financial foundation. Gold and silver are part of a diversified strategy, not a replacement for emergency funds, retirement accounts, or productive assets. Make sure your base is solid before you worry about optimization, and do not stop learning. This correction is revealing something about how markets work, about how institutions position themselves, about how fear and greed move prices. Study it, learn from it, become a better investor because of it. Here's what separates successful long-term investors from the crowd. Patience. Not passive patience, where you ignore your portfolio and hope for the best. Active patience, where you stay informed, maintain discipline, and trust a well-reasoned strategy even when it's uncomfortable. The financial markets are designed to transfer wealth from the impatient to the patient, from the emotional to the analytical, from those who react to headlines to those who understand cycles. Every major bull market in precious metals has been interrupted by corrections that felt devastating at the time. In 1974, gold fell 25% before resuming its climb to $800. In 2008, gold dropped sharply during the financial crisis before rallying to new highs. In 2020, silver crashed 40% in weeks, then doubled over the next few months. If you sold during those corrections, you missed the subsequent moves. If you held through them, you benefited from the larger trend. Nobody knows how long this correction will last. It could be weeks, it could be months. But history suggests that when the fundamental drivers of precious metals demand remain intact, prices eventually reflect that reality. Your job isn't to predict the timing. Your job is to position yourself appropriately and maintain that position through volatility. This means having conviction, but not stubbornness. It means staying informed without becoming obsessed. It means adjusting when facts change, but not when emotions fluctuate. The investors who will look back on this period with satisfaction are the ones who stayed calm, executed their plan, and refused to let temporary price moves dictate long-term strategy. Let's talk about risk in practical terms, because this is where many investors get confused. Risk is not volatility. Volatility is just price movement. An asset can be volatile and still be a good long-term holding if the fundamentals support higher values over time. Risk is the permanent loss of capital. It's buying something that becomes worthless. It's over-leveraging and getting liquidated. It's selling at the bottom because you can't handle the psychological pressure. When gold drops 10% in a week, you haven't lost anything unless you sell. The metal itself hasn't changed. Its properties as a monetary asset haven't changed. What's changed is the price someone else is willing to pay you for it today. If your time horizon is appropriate and your position size is reasonable, that price is just information, not a crisis. Now, this doesn't mean gold or silver can't go lower. They absolutely can. Markets can remain irrational longer than you can remain solvent if you're over-leveraged or overexposed. But here's the risk calculation you should be making. What's more likely over the next 5 to 10 years? That global debt continues growing, that central banks continue expanding their balance sheets, that geopolitical tensions continue rising, that currency stability continues being questioned, or that all these trends reverse, debt gets paid down, inflation disappears, and monetary metals become irrelevant? You're not betting on perfection. You're assessing probabilities and positioning accordingly. And the probability, based on structural factors, not short-term price action, suggests that monetary metals remain relevant to a diversified portfolio. It's worth noting what large, sophisticated investors are doing while retail investors panic. Central banks globally have been net buyers of gold for over a decade. They're not trading it. They're accumulating it as a reserve asset, a form of financial insurance against currency instability. Family offices and endowments, entities with long time horizons and access to top-tier research, maintain allocations to precious metals as part of their overall strategy. They don't eliminate that allocation when prices correct. They rebalance. These institutions aren't smarter than everyone else, but they have structural advantages: longer time horizons, less emotional attachment to positions, and the discipline to stick with strategies through volatility. Retail investors can learn from this approach. You don't need billions of dollars to think like an institution. You need a plan, a reasonable time horizon, and the emotional control to execute that plan without being swayed by daily noise. When institutional buyers see corrections, they often see opportunity. When retail investors see corrections, they often see confirmation of their fears. Guess which group builds wealth over time? So what should you actually do from here? If you hold gold and silver, review your allocation. Make sure it still fits your overall financial picture. If it's grown too large or shrunk too small relative to your target, consider rebalancing. But do so calmly, based on your predetermined strategy, not in reaction to recent price moves. If you don't hold precious metals and this correction makes them more interesting, start educating yourself. Read about monetary history, understand the different ways to gain exposure, decide what percentage makes sense for your situation, then build that position gradually over time. For everyone, focus on the bigger picture. What's your overall financial situation? Do you have adequate emergency funds? Are you saving consistently? Are you avoiding high-interest debt? Is your portfolio reasonably diversified across asset classes? Precious metals are a piece of the puzzle, not the whole picture. They're insurance, not a path to quick riches. They're a long-term hold, not a trading vehicle. Make sure you understand their role in your personal financial strategy before you worry about their price on any given day. And stay informed without becoming obsessed. Check in periodically. Read thoughtful analysis from credible sources. Avoid the extremes of both the gold bug echo chamber and the dismissive mainstream narrative. The truth, as usual, lives somewhere in the middle. And we've covered a lot of ground in this video. Let's bring it together. Gold and silver prices fell sharply, driven by short-term dollar strength, China's ongoing treasury reductions, and market positioning. This created panic in some quarters, celebration in others, and confusion for many in between. But when you strip away the emotion and focus on fundamentals, the picture becomes clearer. The structural forces that support monetary metals over the long term, unprecedented debt levels, currency instability, geopolitical fragmentation, persistent inflation, haven't disappeared. They've intensified, if anything. What we're witnessing is not a refutation of the precious metals thesis. It's a normal, painful, but ultimately temporary correction within a longer-term trend. The investors who will benefit from this environment are the ones who understand that distinction, who can separate signal from noise, who maintain discipline when everyone around them is losing theirs. This isn't about being a gold bug or a gold skeptic. It's about being a clear thinker who understands cycles, respects risk, and positions accordingly. If you already hold these assets, stay calm. Review your allocation, make sure your position size is appropriate, and remember why you bought in the first place. If those reasons still hold, nothing has fundamentally changed. If you don't hold these assets but have been considering them, use this period to educate yourself. Build a position slowly if it fits your strategy. Never invest in something you don't understand. For everyone, the lesson is the same. Markets will test you. They will show you losses and profits, fear and greed, certainty and doubt. Your job is to stay grounded in principles, not swayed by emotions. Wealth is built slowly, through consistent execution of sound strategies, through patience during volatility, through learning from mistakes without being destroyed by them. The crisis in the title isn't about gold or silver falling. The crisis is how most people respond to volatility, with panic, with emotion, with decisions they'll regret. You don't have to be most people. You can be someone who stays calm when others panic, who sees opportunity when others see disaster, who builds wealth methodically while others chase dreams or nurse fears. The information is available. The principles are timeless. The choice is yours. This moment will pass. Prices will stabilize, then move again. New headlines will emerge. The cycle will continue. What matters is whether you're positioned thoughtfully, whether you understand what you own and why, and whether you can maintain that understanding through noise and volatility. If you can do that, if you can stay disciplined, stay educated, and stay focused on what actually matters, then these corrections become learning experiences, not disasters. They become opportunities, not crises. And over time, that difference compounds into something meaningful. Thank you for watching. Stay informed, stay disciplined. And remember, the goal isn't to predict the future. The goal is to be prepared for multiple possible futures, positioned reasonably for each, and calm enough to adjust as facts change. That's how wealth is protected and built over the long term. Take care of yourselves, and I'll see you in the next video.